Welcome to the latest edition of Macro Strategy Views, our quarterly investment strategy outlook for FX, rates, and commodities. In this quarter's note, we focus on the start of the global monetary easing cycle and its implications across asset classes. Slowing global growth, persistent disinflation, and the uncertainty from U.S.-China trade tensions have opened the door to coordinated monetary policy easing. We believe that global interest rate cuts, especially from the FOMC, should support emerging markets in the second half of 2019, as long as growth concerns do not become recession fears. Broadly speaking, we are bullish on duration, we are turning more constructive on emerging markets, and more bearish on the dollar, and we see upside risks to gold prices. In FX, the start of the FOMC easing cycle should start to weigh on the dollar. Interest rates have declined in most markets, and this has eroded the US dollar's interest rate support. Negative yields across much of the G10 may discourage capital from flowing to developed markets, and EMFX should be the primary beneficiary. Our long biases include the Indonesian rupiah, the Brazilian real, and the Japanese yen. And we also believe that CNY could surprise markets by strengthening against the dollar in the second half of the year. In rates, we remain positive on duration, with U.S. inflation set to remain low and the FOMC cutting rates twice in the second half. We see 10-year Treasury yields declining to 1.75%. We also expect the Asian debt outlook to stay constructive in the third quarter, although positive momentum may slow. In addition to the decline in bond yields, the improved outlook for Asia FX and broad dollar weakness should support local currency returns. We are long 15-year Indonesia bonds. We are biased to own the 10-year part of the India government bond curve and 15-year Thai baht bonds, and to receive 5-year forward Korea swaps. Commodity markets, like other risky assets, have found themselves in the crosshairs of the U.S.-China trade war. However, not all commodities have been hit equally. Industrial metals have borne the brunt of selling, as have oil prices, while grains and gold prices have moved sharply higher. We see upside risk to gold prices from the FOMC rate cuts and from growing skepticism of central banks' ability to lift inflation expectations. We wish you a very good third quarter.